Hi everyone, I found a really interesting question I want to share with you. I think it will be helpful for some people. Okay, case study. You have your parent company in US with functional currency of United States dollars, and it sells services. But also you have subsidiary in Euro Union that operates in Euro. Okay? And it also sells services. So here we have United States dollars as an inflow. Here we have euros as an inflow. Subsidiary's functional currency is euro. Here is United States dollars. The group's functional currency is United States dollars. What might be the problem here is unpredictability in euro-denominated revenue. Sorry, in USD-denominated revenue. Revenue in USD is unknown. Quite an interesting case. To understand better, let's recall consolidation rules. Let's recall accounting rules. What's happening at the accounting level? Okay, here straightforward, you sell in USD, you receive USD, you have your revenue in USD. Plain situation. Here, you sell in euro, like assume revenue of 1,000 euro. And you book it as 1,000 euro in your books for European legal entity. What happens at the consolidation level? You book it in a consa at average rate, average FX, average for the year. And you don't know what it's gonna be. This is the consolidation rules. The problem here is that you cannot hedge this transaction at the level of subsidiary because there is no underlying risk you're hedging against. Think about it, it's really interesting. Your company with euro functional currency selling in euros, so there is no underlying risk. You don't have the basis that you want to hedge against of. That's a problem because at the consolidated level, you will have that average rate effects of something unknown for you at the date of sale that will make your revenue fluctuate. So, but there is a solution. Disclaimer here, I'm not tax expert, this is not advice, this is just thinking about the situation. You're creating arm's length agreement between your subsidiary in European Union and parent in euro, where your European subsidiary paying for services provided by US parent. Let's say it's management fee. What's the difference? Now you have USD operating company receiving management fees, and management fees forms revenue in euro. So now you have a risk that you can hedge against, and it's allowed by ASC 815. So now you can hedge this transaction with derivative instruments, forwards, options, collars, other instruments, up to you. What happens at the consolidated level? The revenue itself here is eliminated because it's money between one pocket and one pocket from the view of the group is between. But the but is very important. Is that the effect of your hedge remains at your profit and loss statement in the line you designated to, so it's revenue. So although intercompany transaction is eliminated, your hedge effect is booked to revenue line, and it eliminates fluctuation here. There are a couple of problems, not a couple, a lot of problems here about this type of agreement, legal, tax implications. Also, it's unlikely that you will be able to create same amount agreement here. So management fee most likely will be lower, and you will not be able to cover the full amount. But the concept is there. You can think about it and you can create something if necessary. And by the way, a lot of big guys who operate in different currency environments use this approach. You can go and read financial statements of IBM or Hewlett Packard, and you will find on the hedging section this approach written between the lines, but you can identify it. You can use AI to help you. That's what I'm doing, by the way. Cheers. See you.